Before we begin, this video is for educational purposes only. It is not financial advice. Always do your own research or consult a professional before making investment decisions. 2025 has been a challenging year for investors. But in difficult times, smart portfolios are built. Today, I will show you how to create a simple, recession-resistant ETF portfolio to grow and protect $10,000 safely. Let's get started. Part 1. Why we need this portfolio. In my first video, we learned that no single strategy wins forever. Markets shift. Inflation, interest rates, and global events change everything. Today, we apply those lessons and build a smarter 2025 portfolio for long-term success. Part 2. Portfolio Structure Overview. This is a three-part structure. Core income and stability. Defensive sector hedges. Global growth recovery potential. First in the three-part structure is core income and stability. ETF 1, SCHD, Schwab US Dividend Equity ETF. SCHD focuses on high-quality U.S. companies with strong dividend growth. Current dividend yield is about 3.25%. Expense ratio is a low 0.06%. Historical return over the last decade is approximately 12% per year. Top holdings include Texas Instruments, Broadcom, PepsiCo, and Home Depot. BND provides exposure to a broad range of U.S. investment-grade bonds. Current SEC yield is approximately 4.6%. Expense ratio is 0.03%. Historical return around 3 to 4% annually. Top holdings include U.S. Treasury bonds and high-grade corporate bonds. Second in the three-part structure, defensive hedging. ETF 3 VDC, Vanguard Consumer Staples ETF. VDC covers essential sectors like food, beverages, and household products. Current dividend yield is around 2.5%. Expense ratio is 0.10%. Historical return is about 9% annually over the past decade. Top holdings include Procter & Gamble, Coca-Cola, and Costco. ETF 4, TIP, iShares TIPS Bond ETF. TIP invests in U.S. Treasury bonds adjusted for inflation. Current SEC yield is approximately 3%. Expense ratio is 0.19%. Historical return has been around 2 to 3% per year. This ETF offers protection if inflation stays higher than expected. Third in the three-part structure, global growth rebound potential. ETF 5, VEA, Vanguard FTSE Developed Markets ETF. VEA provides exposure to developed international markets such as Europe and Japan. Dividend yield is approximately 2.8%. Expense ratio is 0.05%. Historical return has been around 6% annually. Top holdings include Nestle, Samsung, and Toyota. Part 3, Allocation Table. Now let's look at how you could actually allocate $10,000 across these ETFs using a balanced, recession-resistant approach. Number 1, SCHD, for dividend income and growth. Allocate 30% or $3,000. Number 2, BND, for bond stability and income. Allocate 20% or $2,000. Number 3, VDC, for exposure to recession-resilient sectors. Another 20% or $2,000. Number 4, TIP, for inflation protection. Allocate 10% or $1,000. And number 5, VEA, for global growth exposure. Allocate 20% or $2,000. That optional growth tilt. If you want more upside, you could allocate 10% into U.S. tech growth with an ETF like QQQM. Reminder, past returns are not guarantees of future performance. Part 4, Final Thoughts. It is not necessary to predict the next winning stock. Consider structure, diversification, and patience. This recession-resistant portfolio offers income, safety, and growth opportunities. Fortunes are often built during market downturns. Build wisely. If this video helped you, please like and subscribe. Comment below your biggest investing goal for 2025. Let's grow smarter, together.